Thank you very much for joining our webinar today about refinancing and home equity lines of credit. Today, we are going to be your hosts. We have Alexandra Rietkov, our loan production manager from the IDB Federal Credit Union. Myself, I am the Chief Lending Officer, Marco Paredes, and we welcome everybody that is joining today. Ale? We have you on mute.
Good afternoon, everyone. Hope everybody's doing well, and I'm happy and excited to be in this seminar. So, Marco, back to you.
Well, thank you, everybody. Again, we are going to be talking on the first part about mortgage refinancing, your first trust refinancing. That is related to the main topic, which is the home equity lines of credit. So with that, let's just start with what it means to refinance a loan. So when you are refinancing your current mortgage, your first mortgage, basically you are replacing your current home loan with a new one. So that involves closing costs, an appraisal of the property just to check the value. So if you want to reduce the interest rates, cut the mortgage payments, and have a better cash flow, or tap into the home equity, basically, if you want to take some cash out of the property, you can refinance for that particular purpose and do only one loan on that, or repay the loan faster. That's another option. Get rid of the mortgage insurance. Sometimes people buys the property or bought the property with less down payment than 20% down, and you have mortgage insurance. So if you want to cut the mortgage insurance and maybe you have already around a year and a half with the property or with the current mortgage, maybe you can check the opportunity to refinance to get rid of that mortgage insurance. Also, if you want to switch from adjustable rate mortgage to a fixed rate mortgage, also that is another option that you can take in order to refinance your loan, or vice versa. Maybe you have already a fixed rate mortgage and you think that you are not going to be on the property more than 5 or 7 years. Maybe the opportunity to go for an adjustable rate mortgage with a lower interest rate can be an option. We can run some scenarios for you guys and see what is more convenient depending on the goals that you have within the next 5 to 10 years. That is super important to have, set up your goals of what you are planning to do, if you want to keep the property or if you want to move to a new or bigger property or smaller property on the next 5 to 10 years. Next slide. The process of refinancing. A current refinance right now on the market is around 45 to 60 days due to the high volume of requests or mortgages at this point. So every single lender is very tight on based on the demand of the people that is right now trying to refinance. It's a lot of people that is working from home and have more time to check into their finances. So that helps, obviously, to them just to see and review what they have and try to make things better with a lower interest rate as the rates that we have today. As I said, the current market conditions is around 46 days in current refinance based on the appraisal that we're going to need to request and the documentation that needs to be provided by the member. As proactive as you are, if you can get the information ahead of time, pay stubs, verification of employment, bank statements, mortgage statements, information about the taxes and insurance at front, we can get these things expedited a little faster and get see if we can get this below the 46 days. Usually on a regular market, we are below 30 days. Next slide. Get proof of refinancing. Basically, the process of getting a refinance is just to lower your interest rate. So right now in our market conditions, we're excited because we are on the historical lowest rates in the market, in the industry. So our 20 years fixed is at 2.5%. Our 15 years, 2.25%, which is really, really low. Our 30 years, excited because we are right now, we're offering on 30 years. So our current interest rate on the 30 years is at 2.875%. So Ale maybe is going to talk a little bit more on that. Lower monthly mortgage payments. So if you are refinancing and you want to get a better cash flow, we can extend the term of the loan so you can get a lower mortgage payment refinance, or just base it on the interest rate that you currently have. Maybe you have 3.5%, and now you're getting a 2.5%. That will cut 1 point of your current interest rate, and you're gonna pay less interest through the life of the loan. Get a new long term, as I said. Well, maybe you're going to extend the term, you're going to reduce the term of the loan. So we'll get on that with you guys and see what is the best option for you. Cash out of the home equity. So if you are planning to do an investment, maybe you have, you know, a lot of equity, you repay faster the current loan amount that you have, and you found an investment property. Maybe you want to buy now a property, you know, close to the beach, and you have, well, no, maybe you don't have the cash immediately in liquid assets, but you have equity on the property, so you can cash out, get that cash and put that as towards the down payment on a new mortgage for an investment property or a second home. Or if you are planning to pay ahead, you know, the tuition of the university or school from your children, you can do that as well. No, or as simple as that, you want to have the home equity line of credit to do some restructure on the property, some home improvements also, that helps you to do the cash out. Or drop the mortgage insurance, as previously said. Maybe you bought the property only with 5 or 10% down, and now the equity of the property is super high, and we can do a very streamlined refinance and get that get rid of that mortgage insurance that doesn't, you know, do anything for you really. So as soon as we can get the mortgage insurance out of the picture, it's better for you guys. Next slide. Cons of refinancing. I don't want to say that, but we have some cons. Closing costs. Obviously, you are going to have closing costs with the new loan. So every time that you are doing a refinance, so you're going to have new closing costs involved, because this is a new loan basically. But the good thing is that we can add those closing costs to a loan, and basically you bring, if you go to the closing, you are not going to bring any money to the table. Or if you want to keep the loan amount, obviously you are going to need to bring some money to the table. The closing costs around usually are around 1.3 to 2%, depending on the type of loan, and if we need to get the escrows involved. So escrows are not cost, but I am just putting that between the 2%. Adding everything. So if you're with another lender, you are refinancing with the IDB Federal Credit Union, we will need to get the escrows in place in order to have your loan ready to make the payments of your taxes and insurance, you know, as is required. But the good thing is that the other lender needs to give you the money back on the escrow. So that will take between 15 to 21 days usually. So they will send you a check, and you can use that money and put that money towards the loan amount, the new loan that you have, and just reduce the balance, and you're gonna be safe, and basically you're gonna be, you know, okay with the new loan. Or simple as that, if you want to use the money to, you know, a short vacation, you can do that too. So that's a good thing. Bad things on doing the refinance of the loan. Can I pay more over the life of the loan? Well, if you are doing a refinance on the loan and you already repay 10 years, for example, you had a 30 years fix or 30 years amortization, and you already paid 10 years on the loan, and you say, okay, I want to refinance, but I want to extend the term of the loan, obviously you are going to be paying more interest through the life of the loan. So we are going to try to recommend you, what is best for you. Really, usually if you already repay 10 years, maybe we're going to recommend you 20 years or 15 years to repay the property faster, but it depends on your scenario. If you really need to have the cash flow, we can go through the 30 years amortization again, which is no problem for us at all. So it's basically on what your needs are at the moment that you are doing. Maybe you are buying a new house and you are doing just a cash out in order to sell the current property that you have. It's worth it maybe to refinance on the 30 years, get the cash out and put that money towards the other property. So makes sense, obviously, to do those things. So we will need to go a scenario by scenario. So not everything is written, in black and white and stone. So every single loan is different because obviously the finances in-house are different case by case. It may reduce the amount of equity you have in your home. That is correct. If we are adding toward the closing costs into the loan, obviously we're going to reduce a little bit the amount of equity that you have, but it's not that much. Usually the recommendation is just to add the closing costs into the loan because that's going to be a difference of $30 to $40 per month if you include the closing costs into the loan. But what you're going to save down the road, reducing the interest, balance the equation. So that is, even that is a con, it's still, is manageable. Next slide. As I said, cost of refinancing can be, well, it depends. So usually on a refinance, it's going to be around 2%. It depends on the loan. If you are going to be doing a refinance, adding mortgage insurance because you want to go over the 80% to 90%, for example, that's going to add the MI, mortgage insurance. That is going to include increasing your cost as well. If you are paying points, also to reduce the interest rate, maybe that's going to include, part of the closing cost. So that can be an average between 2% to 5%. It depends on the scenario. If you're going to be paying interest to the life of the loan, if you're going to pay points, and if you're going to add some other perks through the refinance of your current mortgage. But usually it should be around 2%, around or a little less than that. Including the escrows. Next. The cost associated with the refinancing, we're talking about the mortgage application fee, title search and insurance, loan origination fees, the home appraisal, and a few other additional things that we're gonna be putting, item by item when we provide to you the loan estimate. Right now, I'm just giving you an average really of the cost and percentage amounts, but usually that's what it is gonna be. We're gonna need to give you a loan estimate with the detail of every single item and the cost for each item. Like a mortgage application fee can be around $300. A home appraisal fee can be around the minimum of $550 or up to $1,000. It depends on the size of the loan, on the size of the property. So if your property is over 1.5 million in value, usually the appraisals are a little higher than the regular appraisal. So loan origination fees can be, between 1% to 3%. It depends on the size of the loan. Title insurance, we need to go with the settlement company and quote, how much is going to be the cost for that. About the title search. So next slide. No cost refinancing. That's a marketing thing. To me, really, I've been, in the industry more than 20 years, and we usually, have previously we had a marketing team that was asking us, hey, why we don't say, it's a no cost refinancing, because it really is not truly a no cost refinancing. So it costs you because it's a new loan. So we need to say tell the truth. So it's just marketing. You might have that is no closing cost refinancing at some point, usually. Basically, what it happens is that the cost is going to be tied to the loan. Somehow, you need to review really your loan estimates and see how the lender is doing this. That should be tied to the interest rate. So the YSP that the lender is getting doing the loan. So usually we are a lender, so we keep your loans in our portfolio. That's why we care about what we do with you guys and the interest rates that we provide to our members, because bottom line, at the end, you are the owners of this credit union. So that is important just for you to know that you are not a number, you are a member. So that is the most important part, and we will work with you through the whole process, and I'll let you know which heights, why we are, collecting XYZ fees part of our transaction. So just be sure and ask for your loan estimate so you can, compare apples to apples. Maybe in one type of loan, you're receiving a lower interest rate, and the closing costs are a little higher, but the compensation factor usually of 0.125 in a loan is around $10,000 through the life of the loan. So it makes sense maybe if I'm paying $100 more here versus $100 less in the other one, but it's a 1/8 higher, yeah, let's just compare, apples to apples down the road through the life of the loan with the financial cost. When to refinance? There are several different reasons that you might have to refinance. Maybe you need to, as I said, to lower your payment, to reamortize your loan because you want to do some investments, or just to want to take the advantage of everything at once. Lower interest rate, extend the amortization of the loan or reduce the amortization of the loan, and you also can get, some cash out of the property. So everything can be tied into one loan at the same time. So those are multiple factors that we can use only to the refinance. So why to refinance? Next slide, please. As we said previously, your mortgage interest is higher than the current market interest rate. And sometimes I defer usually on this. It depends on the time that you are living. Maybe you start a loan with 2.5%. No, right now I have my, the lowest, rate possible. It makes sense to refinance, yes or no, if my rate is 2.75? Well, it depends. So if you are gonna do an investment and you need the cash, what is the best, way to do it? Potentially you have a mortgage. If you have equity on the property, that is going to be the lowest interest rate, even that is higher than whatever you have right now. But if you compare with the interest rate that you're going to receive on other type of loan outside of a mortgage, or different than a mortgage, personal loan or line of credit, maybe the interest rate is going to be higher. So it depends on that, on the market. So still, we are the lowest historically rates, ever. So everybody is just gonna be saying that, but it is true. So are we gonna have, low rates until the end of the year? I think so. Yes, it's a possibility that we're gonna still, have lower rates. And maybe on the first, at the end of the first or second quarter, or starting the second quarter of 2022, we're going to see an increase on rates. But so far, I think that until the end of the year, we're still safe. So if you're planning to refinance, I will just recommend to do it now. I don't think that we're going to be as low, as we are right now. You have other debt that you need to reduce. Maybe you have credit cards, you have an educational line of credit, the interest rate is 6% or 5%, that you want to say, well, you want to tie everything into the interest rate that we are offering you right now on a fixed rate loan or one of our adjustable rate loans. So you can repay that faster and put that money aside and pay extra towards principal. Maybe you were paying, I don't know, $300 towards the educational line of credit or the educational loan or your credit cards, you were paying, you know, I don't know, $300-400 per month. So if you combine everything and do a debt consolidation, so maybe that's going to increase a little bit your mortgage payment, but all the cash flow that you are getting out of it, you can put that towards the principal of the loan and repay that faster with a lower interest rate. So that is also an option. We see a lot of those things. Sometimes we get tied on some situations that maybe we are helping family, you know, overseas because something happens and we need to help. That is part of that. Or we have, you know, kids that are, you know, just ready for school and we need to pick the tuition and we don't qualify for educational loan because we are not US citizens or residents, and basically we are G4. Those things happen. So we have, even that we have educational lines of credit, still this is a good option, or our home equity line of credit that Al is going to be talking more about that. That's an or option to get these things done. You want to make some home improvements. Also, if you're refinancing, you can get out of the cash and do only one loan and just get it done. Basically, you are going to start paying over the amount of money that you are doing. Let's say that you are doing, I don't know, you're doing an addition to the house and you need $100,000. So you don't want to have two loans. Basically, this will be a refinancing cash out will be a good option to get the cash out and have the money ready, basically, and you're going to start obviously paying your monthly payment after 1 month after you refinance the loan. So will be, you know, the option to do that. And well, as I said, to pay a tuition, that will be another option. Next slide. Also, if you have an adjustable rate mortgage that is resetting right now, let's say that you start with us with a 7-1 ARM and you already have the 7 years, or maybe you're in 5 years, but you are seeing that the interest rates are better or kind of similar of what you have, and you want to tie your loan to a fixed rate loan, that is an option. So we have a multiple of those requests, as we have the opposite side. So somebody, you know, on the fixed rate that wants to go for 7 years because they don't see that they're going to be staying in this country more than 7 years or 10. So that is the other option, just to refinance from a fixed to an adjustable rate mortgage, or if they're going to be selling the property within the next 10 years or less. Your credit scores improve. So maybe when you start your loan with another institution, your scores were low and you receive a high interest rate. So this is a right time, maybe if your rates are higher than when you start the loan, this time to review. So by saying that, the IDB Federal Credit Union does loans with no credit history at all. So that is just only for the IDB staff employees. So that is the benefit of having, you know, an account with the IDB Global Federal Credit Union. So if you are just arriving to the country and you want to purchase a property, you have 20% down plus your closing costs and some reserves, you are going to be able to purchase a property with no credit history in the US, which is one of our strategic advantages for our members that are IDB staff. So that is something that you guys can, you know, take advantage of that. Or if you are a local country office and staff and you want to purchase an investment property in the US, also you can do that with us with the same kind of a structure. Obviously, that's going to be an investment property. But yeah, it is options that you can do without credit scores. The only thing that you cannot have is, you know, delinquent credit scores. So if you have collections or judgments or liens on the property, that is going to be something that we're going to require that you clean up that before that, but we can guide you through a process. We're going to pull a credit report and show you where we stand and what we need to do to make some improvements. So we work at some of those loans within the 3 or 6 months. They were just refinancing with us very quick. So Ale is just an expert on that, and can give you more details if you guys do a one-to-one with her. You want to remove a co-signer. Maybe you bought the property with somebody else, with a friend, with a fiance that didn't happen, and bottom line, you got separated down the road, and you want to take the other person out of title and the loan. Basically, we need to refinance in order to get this done, and take the person out of the loan and also out of title. So you're the other person need to sign a quick claim deed, and with that, it's gone. So, and you're gonna stay with the loan. So sometimes I call it that is just a peace of mind. So it's just better to get out of the loan and title at the same time, instead of just keeping the person on the loan and just remove that from title, because it can be done too. So if the person just signs a quick claim deed, you can still keep the person on the loan, but you are holding back that person because is responsible of the loan as well. So to be fair, will we just take that person out of the loan and the title as well? Just a recommendation. Current mortgage loan has a private mortgage insurance. Obviously, we spoke already about that. It's just to remove mortgage insurance. Usually, when you are below the current value of the property is below 78% or 80%. Yeah, we can. If you have, let's say, if you have a mortgage with us and you don't want to refinance, but you bought with a MI, mortgage insurance, and the value of your property is skyrocket, and right now the current value is higher than when you bought the property, and based on the loan amount that you have on the current value, you can get rid of the MI. The only thing that we need to do is use an appraisal, make sure that the value is there, and we will be able to remove that mortgage insurance without refinancing the loan and incurring in closing costs. But if you want to get a benefit of just lowering the interest rate, we will need to do a whole refinance on that. If you're planning to stay in your home, basically for several years, as I said, if you're planning to stay more than 5 years, more than 10 years, or just keep the property, really, period. So it's an option just to review always what you have and see, where the market is at this point, just to make sure that you are, you have the right rate and the right product for you. Next slide. Tips used to get lower refinance rates. Just buy discount points. If you want to invest, you can pay 1 point, 2 points. It depends what the lender offers you in order to reduce. In this particular case, we do offer that option of buy down the rate. So if you pay 1 point, you're going to be deducting 0.25 of the interest rate. If your credit score increase, that's another option, basically, to shop around with other lenders. The IDB Global Federal Credit Union offers the lowest interest rate always to their members. So we offer what you see in our website, because we advertise our rates in our website. That's what you're gonna get. So that is the lowest. Even if you don't have any credit scores and you recently arrived to the country, you are not going to have an add-on like other lenders do. Banking usually does that. So if you have, lower interest rates, they will add, 0.125 or a quarter point to your interest rate because your scores are between such and such. So that is something that you are not gonna see in our mortgage loans. We try to be, as clean as possible on what we propose to our members, because as I said before, you are the owners of the credit union, and that's why you need to get the benefits of this credit union. If you use our services of checking, savings, and you are getting personal loans, home equities, and a mortgage, basically that's what we want to give you, the lowest interest rate possible, so we can, earn your business. So that's what we try to do all the time. If you don't open any other credit or loan accounts, basically when you are doing a refinance, my recommendation is really, if you're planning to get a mortgage, so don't apply for a car loan, don't apply for a credit card. So don't buy the furniture before you are doing the loan or you're getting the loan. Why? Because that's going to be an inquiry in your credit. And if it's an inquiry in your credit, it's a possibility that your scores are going to be just going down a little bit. Maybe you apply for a car loan because you saw the property that has a double parking, and you need another car just to fit there. And finally, if you don't buy the car, that is a hit, a hard inquiry in your credit. So that's going to reduce your scores. Save some as authorized user. Have someone as authorized user. I'm sorry. This is if you want to add somebody to add you as an authorized user. So let's say that I have a credit card, but my wife just arrived to the country. That happens a lot with our membership, but she doesn't have any credit history at all. So if I already have credit history and I have obviously a good credit history, I can add the other person as an authorized user on my credit card. And that's going to start reflecting credit history on her, valga la redundancia, in her credit history, in her credit report. So bottom line, yeah, it's an option just to get so if you are planning to qualify and want to add your wife or spouse to the loan, maybe you need to create credit history before you do the loan. So we can work with you guys through that process, which is very important to do that before you apply for any other loan. So we know the type of membership we have, so we are very clear, and we have to use the path to make those things happen and get the best rate and the best product for you. Next slide. Mortgage insurance. We talked already about mortgage insurance. Usually it's an annual fee of 0.5 to 1% of the mortgage loan amount. Basically, if you don't put 20% down, you are going to have MI. If that is what is going to happen. And I told you already that when the ratio reach 78%, the PMI pretty much will be removed. So, but if you want to do that before that time, usually that takes around 24 to 30 months, based on the initial balance and the initial value of the property. So, but if you want to expedite that process, we will need to do an appraisal and get that value and remove the appraisal if you are below 80%. So we can help you with that as well to do that. Credit scores. Who needs credit scores, right? Bottom line, we are a number in this country, and we need credit scores to, get, better products and services. So we have excellent products, but we don't have all. So I'm clear as I can be. So there is a lot of lenders, and we compete with everybody. So we compete for your business, and we try to give you the best as possible. But I can recognize that there is a lot of lenders that they offer also excellent products, but you need to have credit scores and good credit scores, not only credit scores. So the better you have the scores, obviously the better you are going to be able to qualify. So most of the lenders, they request that you have a 620 middle score, 620 middle score. So the range from the FICO scores, as you see, they show 300 up to 850, which is the maximum. The highest that I saw is around 840, which is nuts. It's crazy. So it's like, well, that person has, like 10 accounts with more than 5 years each, paying every single thing on time, no exceeding the 35% of the lines of credit. So those things help you to improve your scores. No, but if you, let's say that if you have a credit card with us and you have around $10,000, but you always maximize, you have the credit card max all the time. So that's not going to help you to improve your credit, even that you have a long credit history. So we need to review that and see if you are towards pushing towards a refinance or get any other type of loan, like a home equity line of credit. We need to see that your limits or balances are below 50%. The sweet spot is 35% of the line, really. So that's going to help you to improve faster the scores. But we can talk more about those things, you know, if you guys want to talk about that one-to-one. We can do some multiple, you know, appointments with our loan officers. We have Ali, we have Carlos, Eric, and our new loan officer, Edwin Blanco, which is just being promoted from our processing department to a loan officer. So I think that we have Edwin. So congratulations, Edwin, that you are here with us on the call. But you guys will see, you know, how my team is going to take care of you guys to help you to improve, you know, and give you the best products possible within the suite of products that we have at the credit union. And with that, I'm just going to pass the ball to Alexandra.
Drink some water. Good afternoon, everyone, again. I'm going to explain a little bit more about our 15 years and 20 years. We are offering right now the 30 years, which is awesome. It's like, it's many of our members receive a lot of requests to quote and close 30-year fixed. The rate is awesome. It's 2.875. And if you like have your mortgage with another lender and you started this mortgage around like 5 years ago, 4 years ago, you possibly have like a 30-year fix with 4%. So bring your mortgage to us because we can evaluate what is better for you. You may have the same monthly payment in a 20-year mortgage with an excellent rate of 2.5. So a good way to lower and build more equity in your property actually will be to change your mortgage in a 15-20-year fixed rate with lower rate and amortization towards principal really accelerated. So that will be a good option. And we also show our members how to use the amortization schedule calculator because that's another way to see how the property builds equity and becomes yours, because you pay month to month and you don't see that your balance is reducing. It's because you have a higher interest rate in a 30-year mortgage. But with us, you will see that that is a better way to get your home paid off easily and fast. Of course, a 15 years, a 20-year fixed rate mortgage will come with a higher monthly payment, but if that payment doesn't adjust your monthly expenses, we can also evaluate an adjustable. We can also evaluate a 30-year fix. So please bring your case to us. We will be happy to evaluate your case. As Marco mentioned, is case by case. And we have to also verify that the debt to income ratio is under 43% to qualify. If you go in, for example, that you don't want to commit in a 15-year mortgage payment, you can go to a longer term and do extra payments. We don't have penalty for prepayments in any of our loans. We're talking about consumer, HELOCs, and mortgages. All of them have no penalty for prepayments. Next slide, please. If you have any adjustable remortgage that you have it for 5, 7, or 10 years, and Marco mentioned also is the time that the rate is going to increase annually, bring it over to us. We will evaluate if it's convenient to do another adjustable remortgage or a fixed rate, or we can see what monthly payment fits your needs. As Marco mentioned, I have many clients that are traveling overseas and they are renting the house. We have to see that the rental income covers the amortization payments, so it can be paid by itself. So we can evaluate that for you. And if you want to cash out the money to invest, to do renovations, we're here for you. So next slide, please. Next one. If you use a cosigner, and that was Marco already explained, we can help you to remove that cosigner from the loan. If you are separating your spouse, you can do the buyout of the property from your ex, and we can help you with that. It's a process that is going to be smooth for you, and we're going to help you so you can be fully responsible for paying your loan. If you add your parents, or you are part of your parents' loan, and you want to buy your own property, we can do that for you and evaluate each set of borrowers, so you can be removed and get your own property. Something that I want to share with you is that all the members at the credit union can extend membership to their relatives. So if you have a brother, a sister, parent, or a son, I have made many loans for sons of retirees right now, that they used to have custodian account, and now they are of age and they're working and they have their own account nowadays. We do offer all of our services, not only mortgages, but all of our services to them. So open an account for them, and we will evaluate their cases case by case within the DC area or other states. So next slide, please. Now, there are many types of loans available. I'm going to talk a little bit more of the ones that we do practice or offer more, but there are many. In some cases, some of them applies to you guys, some of them don't, but there's refinance loans that are called rate and term. That's when you refinance a traditional loan and you lower your mortgage rate and reamortize your mortgage loan. So if the borrower has a conventional loan that want to lower the mortgage payment, this is the rate and term loan. You can include closing costs in them and readjust your mortgage. You may also choose this type of loan to remove PMI, something that Marco already spoke. If you have an LTV or loan to value 78%, and then you can save some money not paying private mortgage insurance. A streamline refinance is a government backup mortgage. Those are called FHA loans, BA loans, USD loans. And a streamline is a process quicker than easier to do a traditional refinance. There's also home affordable refinance loan. During the time of the financial market crisis in 2008, the Obama administration created in 2010 what it was called the HARP program. And that HARP program was introduced to slow foreclosure and allowing borrowers who were underwater to refinance, helping those homeowners. But that program has been replaced in 2018 at the end of 2018 for the Freddie Mac Enhancement Relief Refinance and the Fannie Mae High Loan to Value Refinance option. This will allow borrowers to refinance with less than a 5% equity stake in their homes. We have also cash out refinance loans that you have some equity built in your home, you can tap into the equity that you pull cash out, and you can use that for many purposes. You can either buy another property, or that happens very commonly when you buy another property outside the US in your country office, or in your country of origin. Some people take the money out and buy cash on their country of origin, an apartment or a small house, or they can buy a property in Florida, preparing for retirement. So that's a great option. And the cash out in refinance is when the member puts money. Nowadays, some members have been able to save during pandemic, so they can put money down to lower the balance and reduce their monthly payment. Next slide, please. Home equity loans. Okay, home equity loans are second mortgage in your current home, and the lender will take a second lien holder position on your property. In some cases, and we do offer a lower interest rate of 2.875, the home equity can be considered for first lien if the balance of your current mortgage is pretty low, and then the home equity as a first lien absorb the current balance and leave you a line open for you to use it. So we can evaluate that. It has a lower closing cost. We still need appraisal and application fee, but it's an option that we can evaluate if that is your primary residence around this area. So it has to be your primary residence to do a home equity loan in the property. If you ever default on this loan and the property is foreclosed, the first lien is always gets paid first, and the second lien gets what is left. So for many lenders, it's a little bit riskier to do a home equity. Therefore, the interest rate is a little bit higher. So having a home equity also restrict when you have a poor credit history or poor credit score. So that is something that the lender will evaluate too. And it will provide you with a lump sum payment that you can use as you please. Renovations, education purposes, buying another property, investment. So it's a money that you can use for a large purchase or vacations, etc. Next slide, please. Home equity line of credit. That is what we offer in our website. A line, it's used similar to a credit card. So what we're going to do is we're doing appraisal. We're going to evaluate the value of the property. We're going to calculate either 80% if it's first lien or 75%, and we're going to subtract what is your current mortgage balance. The difference of that is what is going to be your home equity line of credit. And we have 3 rates in our website for these programs. The rate is adjustable annually based on a margin that is constant. We have a cap for increases in rates, but you can use the line of credit as you please. So you will open your credit union account, you will see your savings, checking, other loans if you may have them, your mortgage, and then you will see your HELOC. So you will go into your HELOC or your line of credit, let's say it's $100,000, and you can pull like $20,000 and put it on your savings, and you can do repairs, you can do renovations, you can buy a car, you can pay tuition, and then you're gonna pay interest only for the first 10 years, amortization in full after that for 15 years. There's no penalty for prepayment as we mentioned below, so you can prepay the interest only anytime, and along with some partial payment towards principal that will liberate, like a credit card, the space in your line of credit to use it for future. And next payment of interest is going to be lower because your balance is low. Next slide, please. Okay, pros and cons of an equity line of credit. Well, you will pay interest only on the amount you borrow, but as mentioned before, you can prepay. You will have a low interest rate. In our website, you will see our low interest rate. Someone may offer similar to our interest rate, but look at the cap of the rate. I have seen that members been tricked, like offering like this low rate, but it can go up to 26%. We don't have that. So our cap is 6% in addition to the original rate. So that's a very important element that you need to see because it's a loan for 25 years or 20 years. Now, get cash to make renovation or repairs. Yes, you can do it. So anytime you can pay off and borrow at any time. Yes, it's available for you to use it. And no fees to take out cash. Correct. We don't charge annual fees. We don't charge monthly fees or maintenance fees in the HELOC. And it can increase the value of your property. Yes, nowadays, if you see the tendency in the market, we're in a small bubble. So many properties has been increasing value lately, and you can see how many sales around your area are. So it's highly possible that if you bought like 5, 7, 10 years ago, your property value is like much higher what you spend, and you're building a lot of equity in the property. So contact us if you want to do an evaluation for that. That's about pros. Now, next slide. Cons. Okay, it reduces your equity each time you use it. Yes, because you are using part of the build up equity that you created in your property. It has a variable rate. Yes, it's adjusted annually in the anniversary of your mortgage. But as I mentioned to you, we have caps to control the increase or decrease of rates, and we have a life cap of 6% in addition to the original rate to keep that rate low in the market. Could you face foreclosure if you're unable to make payment? Yes, because if it's a second lien in the property that has a place of on the lien in the property itself. And closing costs, it depends of the limit of the line of credit and the state where you live, because some state like Maryland and Virginia charge recordation taxes. DC doesn't, but still we have to request that from a recommended settlement company or suggested settlement company. Next slide, please. Okay, so are you ready to tackle your refinance process? It's very important that you keep like a a list and see what you want to do. Like set your goal. What do you want to do? You want to reduce your monthly payment? You want to pay off your mortgage faster? You want to get rid of mortgage insurance? Do you need cash for something or consolidate debts? Do you have high balancing credit card debt that is always there and it's a compound interest with 26%, 23%? And you have equity? Include that in the refinance. You will feel so free to only have a mortgage payment and no other debts, that to have like 6 payments that never goes down. What you have to do is also shop for the best mortgage company to refinance. We're talking about the lender, and check out the fees. Always request what is called a loan estimate, because the loan estimate tells you in detail what are the fees involved in this transaction. And we are so happy to let you know that all of our members know that our fees are to the dime. Unless there are changes of circumstances like increased loan amount or change settlement companies, etc., or including another loan. So if you absorb another mortgage or something, we will evaluate that with you. Now, what you have to do is apply also. If you have that in mind, you have to apply for a couple of mortgage or lenders to see what is the best option, and also do that within a 2 weeks period, because every lender that you authorize on the application to run your credit is going to generate an inquiry that will lower your credit score. And many lenders do credit scoring. In our case, we're pretty straightforward. What we have in our website is what we offer. So check about that. Also, next slide is going to be choose your refinance lender. So once you pick your best offer, go for it, request a loan estimate, made them accessible to the supporting docs that they request. In the lending industry nowadays, in the mortgage industry, we require several documentation. Now it's easy because you can upload it secure in our website for the mortgage application, and then we will log your interest rate. We're going to meet with you. We're going to check what is the monthly payment. If you want to buy a point or buy a point, we can check that with you and log your rate. Also check your closing costs and help you in that process. And then once we do the appraisal and the report is coming to us and everything is all right, we will pass your loan for closing. And this is when you gonna pay those closing costs either upfront if you don't want to include them, or in the loan amount, because the difference is not much sometimes, and we show you those estimates to see what is the best option, if you include it or not include it. Now, a mortgage refinance is not a difficult process. We're going to guide you all the steps, in all the process, in all the steps that you need to follow. And basically, these presentations that give you the keys to do a refinance or a HELOC. So please feel free to contact us. Access to our website. Next slide. That's IDB, www.idbglobalfcu.org, clicking products, clicking mortgage, and apply online. It's very easy. We have the calculator too for amortization schedule too. And it's super easy because we will contact you as soon as we receive your application to assist you with the process. And thank you from my side. Marco, you want to add something?
Thank you, Ale. I'm going to take it from here. Thank you for all that those amazing insights. Team, I just wanted to let you know I didn't have a chance to talk to you at the beginning, but just to let you know that this webinar is recorded. So we will be posting it on our website in a couple of days once we receive the final recording. And additionally, at the end, we're going to send you a survey. Your opinion is very, very important to us. So please make sure you fill out that survey. And one final Q&A portion or housekeeping element is if you do have questions, please put them in the Q&A. We're kind of at the end of the webinar, but we would be happy to get in touch with you or answer any final minute questions right now, actually. So if you do have anything, please put it in the bubbles at the bottom, the 2 little bubbles themselves. Also go to idbglobalfcu.org. You will see that we have a lot of webinars throughout the year. Please make sure you check them out and join us because we have a lot of interesting and great information. So for there, I will pause for a second and check and see if there's any questions. None. Wow. So
Oh,
Marco and
good,
Ale
good to
did an
hear.
amazing job that there's not even one question. So we will leave right now. If there's anything else, you know where to find us, then please email us. Thank you, everyone.